Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. Why you build your own signals. Listen only to what the market is telling you now. Forget what you thought it was telling you 5 minutes ago. The sole objective of trading is not to prove you're right, but to hear the cash register ring. Marty Schwartz. The purpose of creating buy and sell signals is to capture a trend's profitability inside your trading time frame. Let's think about the creation of a trading edge and its many levels. First, we can consider that taking trades randomly should give us a 50/50th chance of being right or wrong. If we flipped a coin before we entered a trade, half the time we should be entering in the right direction whether long or short, and price should move in our favor theoretically. How can we improve these random odds? We can go in the direction of the trend in our time frame on the daily chart while using the weekly chart to monitor the larger trend. While the stock market has a bias to trend upwards in longer time frames, buy and hold investing is not more profitable because large profits are given back during bear markets. Trading stocks from the long side during bull markets and removing the short side during bull markets will move the odds in your favor by better than 50%. The stock market goes up more than it goes down over long periods of time. There are more bull markets and range-bound markets than downtrends, markets crashes, and bear markets. Shift to a long-only strategy during bull markets will help you develop an edge in these environments. Contrarian traders with no valid reasons for their actions frequently miss stock market uptrends. Buy and hold investors hold their stocks during bear markets when they shouldn't and give back years of gains. Capital flows and creates trends in all markets over longer time frames, and it's much easier to go with the direction of the flow than to try to predict every turn and reversal. The majority of profitable traders I know personally trade with a trend. The easiest way to filter a trend is using moving averages. Moving averages smooth out long-term price movement, and can show you the ascending or descending trend in your time frame. They are used in building most trading systems. Trading on the right side of the key moving averages in your time frame will give you your first edge over other traders. Your odds of being right improve to more than 50% when you systematically stay with the right moving average. Enter with a great risk-reward ratio. Always buy with a good margin of safety. When a stock or index is in an uptrend and then pulls back to a key price support level, technical oversold level, or ascending moving average, you can enter with a stop loss that is set outside the trading range or lower than the key pullback area. The odds of your trade being a winner are greatest when the probabilities of your stop loss being hit are the lowest. After entering in the direction of the trend, you want to be profitable before you are stopped out for a loss. Your position size has to be small enough to allow you to manage your emotions so you can stay in a trade until there is a valid reason to exit. Your trade size has to be big enough to make a win meaningful, but small enough to not put your trading account in jeopardy. You should never expose yourself to the potential of large losing trades. You must be able to survive losing streaks because they will come. The simplest strategy for risk control is not to allow your losing trades to cost you more than 1% of your total trading account. If you're trading with 10% of your total trading capital in one position, then your stop loss can be 10% below your entry for a 1% loss of total trading capital. If you're trading with 20% of your total trading capital, your stop loss should be 5% below your entry price for a 1% total trading capital loss. If you are trading with 25% of your total trading capital, your stop loss would have to be 4% below your entry price for a 1% total trading capital loss. Part of taking an entry signal will be position sizing correctly to avoid any large losses. Not trading too big will give you an edge over traders that have to go all in on every trade because they have small accounts. Position sizing will give you an edge over other traders and help determine your long-term success. If 1% at risk seems too small, it is likely that your trading account is too small. Your trade signals will be risking a small amount trying to make a large amount. Your stop loss is the brakes and your profit target is your destination. Your signals will only work if you are risking a little to make a lot. If you are risking a lot to score a big win, then those risks will eventually catch up to you. Even professionals like Victor Niederhofer, long-term capital management, and Amaranth learned the lessons of the risk of ruin the hard way. Exit when the risk is greater than the reward. The next step in our signal example is to see exactly where we would exit after our entries. Some studies by Van Thorp and Tom Barso have shown how even random entries can be profitable if the exit is managed to create big wins when the trade trends, and small losses when the trade goes in the wrong direction. Tom Barso designed a simple, random entry trading system. We determined the volatility of the market by a 10-day exponential moving average of the average true range. Our initial stop was 3 times that volatility reading. Once entry occurred by a coin flip, the same 3 times volatility stop was trailed from the close. However, the stop could only move in our favor. Thus, the stop moved closer whenever the markets moved in our favor or whenever volatility shrank. We also used a 1% risk model for our position sizing system. We ran it on 10 markets. And it was always, in each market, either long or short depending upon a coin flip. It made money 100% of the time when a simple 1% risk money management system was added. The system had a trade success reliability of 38%, which is about average for a trend-following system. Source: Van K. Thorp, Trade Your Way to Financial Freedom. To limit randomness and create a profitable system after you enter with a trade in the direction of the trend, you will set up your sell signals to limit losses. At the same time, you should allow your winning trades to grow as big as they can before your price target is met. Trailing stops like ascending moving averages and ascending trend lines are tools to help you maximize these gains. Reaching a price target to a descending moving average, at a round price number, or at an old price resistance is another great time to take profits off the table and look for a better risk-reward ratio for your next entry. Remember, the easiest path to profitability is to create asymmetry in your trading so you have big wins and small losses. Another key to trading profitability will be the ability to hold a winning trade and let it go as far as possible and not exit it until there's a valid reason. Winning trades should only be exited for a reason and not an emotion. You will need the big wins to pay for all the small losses, and cutting winners short will greatly hurt your profitability. Do not get out of a trade until your signal tells you to, but when it does, then get out.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.